Okay, I hope everyone enjoyed their lunch break. We're now going to move on to the next panel, the panel of Economics and Innovation. But before we do that, we're going to hear some opening remarks from Marios Psaltis from PwC Greece. Thank you.
Dear London School of Economics Hellenic Society members and guests, it is my great honor to offer the opening remarks to the Economics and Innovation panel and to be part of this year's conference of the Hellenic Society of the London School of Economics, which has the inspiring theme Semper Ad Meliora, always towards better things. This theme encapsulates the ongoing process for human evolution, but in my view, it also reflects the effort that Greece is currently making to move beyond the problems of its recent past and thrive in a dynamic and changing global environment. When the pandemic broke out 2 years ago, the Greek economy was at a stage where it was starting to grow again after a long period of recession that saw the country's GDP contracting by more than 25%. The unprecedented restrictions imposed on the economic activity as a response to the pandemic threatened to impair the fragile recovery of the Greek economy. The legacy problems of high debt, high taxation, high level of non-performing loans, and the structural problems associated with the over-reliance of the economy on the tourist industry and its fragmentation into large number of small enterprises rendered extremely problematic the ability of the country to respond effectively to the new health-related crisis. Despite the challenges, Greece responded unexpectedly well, showing remarkable resilience and quick reflexes in managing this crisis. The support provided by the European Union, including amongst other things the relaxation of the fiscal rules and the inclusion of the Greek bonds in the pandemic emergency bond buying program, enabled the Greek government to effectively support the employment and businesses that were adversely affected by the restrictions. The effective response to the crisis significantly improved the level of trust within the society and raised the overall image of the country abroad. In my view, Greece took note of Winston Churchill's famous observation, "Never let a crisis go to waste." And despite the embedded natural fatigue resulting from the previous prolonged recessionary period, this time the response was much more decisive. The dramatic changes caused by the pandemic uncovered a fresh perspective, enabling the Greek people, the government, and the companies to look ahead with confidence into new opportunities for growth. The abrupt disruption accelerated the much-needed transformation of both the private and public sector, with technology being the catalyst of change, delivering a new digital experience for Greek citizens and employees. Examples of these changes were the immediate adoption of remote work by the companies, the introduction of e-government services, which is a brave attempt to digitize bureaucracy, the expansion of electronic transactions, and the highly effective execution of the vaccination program that provided a positive experience to the citizens. In addition, the continued effort to reform the public administration, together with the reduction of the red tape and the taxation rates, as well as the introduction of special tax incentives for relocation, contributed to the gradual improvement of the investment sentiment and the reversal of the trend of brain drain. The recent technology-related investments in Greece by Pfizer and Microsoft, the acquisitions made by large private equity firms of Greek companies in various industries, the acquisitions of Greek startups, including the recently announced mega transaction between JP Morgan and Diva Wallet, are examples of the improvement in the investment sentiment. However, these investments do not only provide a positive signal for other players to look into Greece, but in my view, what is more important is the overall positive impact that such investments will have in the transfer of know-how, the boost in research and development, the creation of jobs in alignment with the new digital age, and a call for our talents to return to Greece, creating an ecosystem of innovation and growth. In this context, we at PwC Greece have recently initiated the Landing Home campaign, and we're determined to bring back home bright, talented people who want to make a difference and help our country to unlock its potential whilst advancing their own careers. Looking ahead, in addition to the private investments already taking place, the funds allocated to Greece through the Recovery and Resilience Fund create a major opportunity for transforming the economic model, shifting the emphasis towards the green and digital transition, innovation, and extroversion. The funds allocated amount to 18 billion in grants and 13 billion in loans. The National Recovery Plan, approved by the European Commission, includes projects for energy-efficient renovations and clean urban transport, as well as a focus on improving the population's digital skills, both in terms of education and reskilling and upskilling the workforce. The plan also includes reforms of the labor market, digitalization of the public administration and businesses, all of which will be key for the modernization of the Greek economy. Taken together, the plan provides a unique opportunity to put the country on a more sustainable growth path. As we now move to the post-COVID era, we should not underestimate the new challenges emerging relating to the expected rise in the interest rates and inflation. These come in addition to the legacy problems of the debt sustainability, the need to reduce the remaining non-performing loans, and the modernization of the public sector, especially in the areas of education, health, and the judicial system. One of the positive effects of the handling of the crisis was the restoration of trust within the society and externally with the markets and the investment community. It is now critical to ensure that this level of trust is maintained. To do that, we need to restore fiscal discipline as soon as possible, continue to adopt more investment-friendly policies, and push forward the required reforms in the public administration. At the same time, the acceleration of the implementation of the national plan through the absorption of the EU funds will create the virtuous forces required to drive the economy to a trajectory of transformation and sustainable growth. Closing my opening remarks, I would like to reiterate the positive steps that we have achieved during the last few years as a country, improving the overall trust. I would also like to stress the need to do more going forward, as we should aim to identify sustainable solutions that will address the important legacy problems and tackle successfully the new challenges that lie ahead. We should aim higher, always towards better things. Semper Ad Meliora. Thank you again for the opportunity you have given me to address your conference, and I wish you all the best.
Thank you, Mr. Psaltis, for your opening remarks. We now yield the floor to the moderator and the speakers.
May I ask the speakers to turn on their cameras, please? Ladies and gentlemen, dear friends, unfortunately, due to a last-minute impediment, my dear friend Dimitris Tsotsomokos will be unable to participate in this discussion and moderate it. The organizers have instead kindly asked me to replace him. I am Christos Hadjiemmanuil. I'm a visiting professor of law here at LSE Law School. I am also the professor of monetary and financial institutions at the University of Piraeus in Greece, and a member of the Monetary Policy Council of the Central Bank, the Bank of Greece. Our discussion today concerns the current state and prospects of the Greek economy, and in particular the significance of innovation for its future structure. To discuss this issue, we have asked three outstanding figures: the current and the former ministers of finance, and the business leader currently engaged in major investments in Greece, to provide illumination. My good friend, the Minister of Finance, Christos, is a leading Greek politician. He serves as member of the Greek Parliament since 2007 without interruption. He also happens to be a professional economist, having worked in the private sector at a major bank, and he's the Associate Professor of Finance at the Economic University in Athens. Minister Staikouras, if you'll allow me to say that, has weathered remarkably well the challenge of the COVID pandemic. I will simply point to the relatively limited impact of the pandemic in 2020, despite the fact that, as we all know, Greece has a services-based, highly procyclical economy. I will also point to the economy's excellent performance in terms of growth in 2021, and most importantly, the fact that during the pandemic years, unemployment, rather than going up, has dived by 4 percentage points, if I'm not mistaken. And in my view, The fiscal interventions designed by Minister Staikouras have undoubtedly played a major role. We will be interested, however, to hear how he plans to address the new macroeconomic environment, which is characterized by the ongoing energy crisis and higher than expected inflation. Professor Gikas Hardouvelis is my colleague at the University of Piraeus, where he holds the chair of finance and economics. He also happens to be the chairman of the board of directors of the National Bank of Greece, which is Greece's most historic bank, having been founded in 1836, if I'm not mistaken, and presently one of the 4 systemic credit institutions of the country. A renowned economist, Professor Hardouvelis has served as Minister of Finance from June 2014 to January 2015, when he made a major and I believe underappreciated contribution to the economy's restructuring and the country's exit from the country assistance programs. Last but not least, Mr. Alex Fotakidis is a partner of CVC, the private equity fund. CVC, of course, is a world leader in private equity and credit. It holds some, well, I stand to be corrected here, but I believe that it has some $120 billion of assets under management. And Mr. Fotakidis is heading CVC Greece, its Greek part. He has joined CVC in 2006. He's a Master of Science in Environmental and Natural Resource Economics. He also holds a Bachelor in Economics and Geography, having studied at University College London. So all 3 of our speakers are exceptionally well qualified to discuss the topics of the present panel. In terms of time management, I will ask the speakers to make a few introductory remarks. I will kindly ask Minister Staikouras to launch the debate, followed by Mr. Fotakidis and then Professor Hardouvelis. We will then hold a discussion with the panelists. And for the last half hour, we will open the discussion to the floor by taking questions from the audience. Now, since this is a combined physical and web-based event, insofar as persons attending electronically are concerned, I will ask them to register their questions in the discussion boxes. And when the time comes, I will read them out on their behalf. So let me please ask Minister Staikouras to launch the meeting with his remarks.
Thank you very much, Christos. First of all, I would like to congratulate the London School of Economics Hellenic Society for today's insightful hybrid event, and to thank the organizing committee for offering me the opportunity to share some thoughts and exchange views on the current state of play and the prospects of the Greek economy with distinguished speakers and a high-level audience. And I would like to thank you personally, Christos, for your valuable contribution on challenging issues we face together through your involvement in the Bank of Greece. Ladies and gentlemen, last year was globally a year marked by high volatility due to a series of challenges and difficulties in the field of health, climate, energy, and geopolitics. However, for Greece, despite the multiple exogenous crises, 2021 was a year of strong V-shaped recovery, according to all estimates. Yet, Greece's recovery is expected to be the second highest in the euro area, according to the European Commission's winter economic forecast. Furthermore, last year's economic recovery is expected to be followed by high, sustainable growth this year, as well as in the coming years. According to the European Commission's forecast, Greece will present the second highest cumulative growth rate in the period 2021-2023. Therefore, it is evident that Greece has efficiently tackled the multiply exogenous crisis in the aforementioned period. Its economy has depicted remarkable resilience, and we have managed to prove and to pave the way for a swift and strong recovery and high and sustainable growth, recovery and growth. All the above reveals a strong impetus reflected in a number of data. Investments and exports are strengthening. Mr. Psaltis mentioned some of these, and I'm sure that Alex Fotakidis will share his views on that. Among others, we have attracted important investments through Microsoft, Pfizer, Cisco, Digital Reality, Deloitte, Volkswagen, JP Morgan. Industrial production is steadily increasing. Economic sentiment reached a 21-year record high in January, outreaching the European average. Unemployment is shrinking. Greece achieved the highest decrease in unemployment in the euro area during the last 4 years, according to a recent ECB report. Real disposable income increased 6 times more than the European average, reaching the second highest increase in the euro area in the third quarter of 2021, according to the same ECB report. Obviously, in the following months, the significant inflationary pressures have put a heavy stress on household incomes. However, the impact of these pressures is softened by the previous rise in the disposable income, stemming from the reduction in taxes and social contributions, and the efficient support measures implemented by the government. Moreover, I'm sure that Mr. Hardouvelis will share with us some data. Bank deposits of households and enterprises are increased, non-performing loans are decreasing, the competitiveness of the economy is improving, and finally, cost of borrowing in money and capital markets is affordable, taking into account, of course, the current European and international market circumstances. The impetus of the Greek economy is also acknowledged by all our European partners, international institutions, rating agencies, and investors, thanks to the implementation of a prudent, coherent, reform-oriented, and insightful economic policy. Consequently, the big picture of the Greek economy is positive, and its prospects are even more positive. However, we are not celebrating, nor are we resting on our laurels. We are fully aware of the fact that despite the promising big picture, the snapshot is blurred because of serious difficulties and challenges. On one hand, Greece's public debt is sustainable, as it is acknowledged by every European decisional estimate, but it is significantly high. The state budget has a primary deficit, resulting from the need to offer an adequate safety net for the society amidst the pandemic and other crises. Greece is still in an enhanced surveillance framework and has not an investment-grade status. Moreover, at the European level, monetary and fiscal policy will gradually become more restrictive. In the absence of investment-grade status and in an environment of uncertainty concerning monetary policy in Europe, Greek sovereign bond yields are more sensitive in international volatility. And of course, we are still facing challenges emerging from the COVID-19 pandemic, the energy crisis and inflation, climate crisis and green transition, along with new and pre-existing geopolitical challenges. Therefore, it is of utmost importance to continue implementing a prudent and responsible economic policy, to continue supporting the society against the aforementioned challenges, but to do this through targeted measures in the context of the budget's estimates, and to continue structural reforms and privatizations. To that end, going forward, we have built an economic strategy setting realistic objectives, achieving high growth rates in the coming years, further improving the quality of growth through significant increase in investments and exports, exiting the enhanced surveillance mechanism in 2022, achieving single-digit rate of non-performing loans in 2022, moving towards fiscal balance in 2022, and achieving realistic primary surpluses from 2023 onwards. And finally, obtaining the investment grade in 2023. To meet these objectives, we're implementing an economic policy based on 7 pillars. First of all, targeted support for households and enterprises over the several exogenous crises. Secondly, implementing a prudent fiscal policy in the direction of further reducing taxes and social security contributions. Thirdly, implementing a smart issuing strategy to maintain strong cash reserves. Moreover, enhancing liquidity in the real economy, as well as implementing structural reforms and utilizing the public property. Among others, our priorities are to broaden the tax base by further improving tax collection, fighting tax evasion and smuggling, increasing public sector's efficiency and productivity, promoting digitalization in the public and private sector, improving the educational and the justice system, incentivizing innovation and investments, lifting existing entry and other barriers in goods and service markets, and finally enhancing transition to a green, sustainable economic model. And finally, rationally utilizing the available European funds, as Mr. Psaltis mentioned before, having at the forefront the Recovery and Resilience Fund and the new NSRF, totaling around 8 billion euros up to 2027. Finally, actively participating in the initiatives for the new European economic architecture. Ladies and gentlemen, to conclude, despite difficulties and international volatility, Greece is efficiently implementing policies which provide the impetus to form a more resilient, sustainable, and inclusive post-COVID-19 economic landscape. Policies which have already created the preconditions for strong and sustainable growth. Policies which allow us to be realistically optimistic that our country, our people, and the whole Europe will manage to walk in the path of Semper Ad Meliora, always towards better things, as you have successfully entitled your conference this year. Thank you, Christos.
Thank you so much, Minister. May I kindly ask Mr. Fotakidis to make his introductory remarks?
Thank you, Christos. Good afternoon, everyone. It's a real pleasure to participate in the panel today, and I look forward to the discussion. And in particular, the foundations that Mr. Stakouras laid out are exactly the reason why we as CBC decided to invest in Greece, and actually why we now have an office here with a team on the ground. And Greece is one of the 25 countries globally where CBC has a local presence, and Greece is now firmly on the map for the firm. It's been a journey getting here. We started looking at Greece 5 years ago, and actually we started off with small steps in the healthcare space, the investment in Metropolitan in early 2017. But since then, we have invested more than 1.5 billion of equity across 5 main platforms the healthcare platform with Hellenic Healthcare Group, the e-commerce platform with Scrooge, the FMCG platform with Vivatia and Poloni, the insurance platform with Ethniki, Asfalistiki, which we're hoping to complete in the next few months, and most recently in energy with our investment in PPC. And I think the exciting news is that even though we have been active in the last 5 years across those investments, actually, and for the reasons that Mr. Stakouras laid out, when we see the prospects of the country, we would like to double our investment base, and hopefully in the next 5 years we would be looking to invest close to 3 billion compared to the 1.5 billion we invested in the last 5 years. And I think that's really sort of the vote of confidence that we have in the country, in the government, and why personally I'm excited to be here and to be leading the effort. I look forward to spending a bit more time about all the projects that we have invested in as a discussion progresses.
Thank you so much. Gikas Hardouvelis now will have the floor in order to make his remarks, and then we can proceed to the discussion.
Thank you, Christos, and I also would like to thank the LSE Society for bringing us together. And it's good for actually the Greeks of the diaspora to get together and create a network of support for the country. I'm going to try to be complementary to what you've already heard, and I have some transparencies which correctly the minister anticipated, so I'll try to share them, see if I can manage it. Do you see the Christos? Do you see the?
Absolutely, we can see.
Okay, excellent. Okay, I'll try to be quick and be let's see, as fast as I can. And the first point is what Minister Stakouras mentioned. I think there is optimism about the macroeconomy. There is solid growth in Greece. In fact, our chief economist at NBG thinks the year may close even above 9%, the year 2021, almost close to 10%. And we expect a growth of about 4.5% next year. What you see here on the left table, the green is Greece, the black is the European Union. You definitely see that in the future, everybody's forecasting much higher growth in Greece than the rest of the euro area. Sure, inflation has picked up. Inflation is on the left that you observe here. Again, the green is Greece, the black is the euro area. Here it's a bit tough to make a quick prediction. I think we were a bit more optimistic about inflation 3 months ago. Now with the events in Ukraine, things have turned a little bit less rosy. Inflation may be with us a bit longer before it subsides. So the elephant in the room is really the war in Ukraine, and we have to watch. I think if a war takes place, this is going to shave growth from the global economy, perhaps 2 percentage points, and it may bring global inflation up. So Greece, more or less, will be affected similarly like the rest of Europe and the world. But I do think we as Greeks, we have, since that 10-year crisis we went through and managed it, we have developed the reflexes to kind of tackle these crises, and we have proven it. I mean, we've proven it during the pandemic. Let me take another look at the macro situation, which is the fiscal side, which Mr. Stakouras did mention this. On the left-hand side, I have the debt to GDP. This is the basic indicator a lot of people see. And here you can see something that differentiates us from the rest of Europe. The green bar is the Greek debt to GDP. It did go up in the year 2020 above 200%, but it's slowly climbing down. And you can see that the number is coming down. Now the rest of Europe is a bit below 100%. It's down here. And when it comes to the flow, what's happening every year, you probably see on the right-hand side that we did have huge deficits during the crisis years. I mean, that's why we had a crisis. We had a crisis. That's why we needed the support of the Europeans to finance us. But now, in the previous, since 2016 on, we started developing some surpluses. Now the pandemic came. We had again deficits, but the deficits are shrinking. And as Mr. Staikouras mentioned earlier, we may have a primary surplus in the year 2023. You see the green bar, which is the total deficit here, is very tiny. So if you subtract the interest payments, it's going to go into positive territory. So there's a lot of discussion now in Europe about the fiscal situation in all of the European countries, and the Stability and Growth Pact, which is, it's a substitute for a political union. We as Europeans in the Euro area, we have a common monetary policy. We didn't take the step for a political union, for a fiscal union. We substituted that with some rules that said, okay, let's all behave prudently, and we had the Stability and Growth Pact. There's a long discussion on the Stability and Growth Pact now among the various countries as to how it's going to shape up in the coming years. To me, it seems like it's not going to go back what it used to be. It ought to combine both rules and flexibility, but flexibility with governance, with rules on flexibility, of what type of flexibility you have. But I'm a bit optimistic that eventually the bargaining, Europe moves in small steps, and after crisis, it does great things. This pandemic crisis sort of neutralized the debt somehow. It began the mutualization of debt. The previous Greek crisis brought a lot of great things like banking union, the beginning of the banking union, or the ESM, etc., etc. Anyway, that's the short run. The short run things look good. The longer run, I think this is one of the few times one can definitely say with certainty that Greece is in the beginning of a big wave of growth, perhaps a 10-year growth. I'd like to hope it's even bigger. I hope this is a wave of a 20-year growth. And what gives us this feeling of more certainty is what people already mentioned. Both Mr. Psaltis and Mr. Staikouras, is the Stability and Growth Fund. Mr. Staikouras added the traditional money we get from Europe. It brought up the 30 billion to 80 billion, it's true. It's up to us to actually utilize those funds, and they're going to be going to good use, to the green transition, to the digital transition, employment and social cohesion, and private investments, etc., etc. This anchor gives us this sense of feeling comfortable that indeed, together with our effort to reform the country, we may really be seeing a new Greece coming out of the ashes of the crisis. So that's all I wanted to say on this. The other item I want to touch on, which was mentioned by the previous speakers, is the issue of interest rates. Interest rates, is a fundamental price. It determines lives across the world. It determines the financial system. We have gone through an era, an unusual time of very low global rates. To me, was not very natural. I always felt nervous. Now that the rates are going up, I don't see it as bad. I see it as going back to normality. And what I have on the picture is the last year The red line is the 10-year German bond, which was negative rates in Europe. The green is Italy, and the blue is Greece. You see the Greek rates were like 1%. It's unbelievable if you were to compare this with the time of the crisis. And in the last month, it has gone up to 2.5%, 2.6, 2.7%. Now, this is actually what you see, the last value of perhaps 3 days ago when I picked it up. And also you see that the spread with Italy, it has gone up a little bit, but I don't think it reflects a difference of opinion about the macroeconomy. It's liquidity. It's the fact that there are not too many Greek bonds around. So when things turn out bad, people feel insecure to keep their money in an instrument that's not a huge supply, and they cannot leave very quickly without affecting the price. So that's what this reveals. Anyway, we're going back to normal rates for banks. And since I'm the chairman of NBG, I do worry about banks. It's actually good. Banks can make better money if rates are normal. They don't like zero rates. They don't like negative rates. It's very difficult for them to behave, to maneuver, to attract deposits, give loans in a strange era. Now it's good for banks. For the state sector, of course, it's negative in some sense that you have to borrow at more expense, but it's not worrisome in my view. First of all, in the short run, a lot of the debt is financed by the Europeans. Our cost of funding is only 1.5%. The rising rates will perhaps hit the public budget much later. And there is this possibility that not only, I mean, the risk-free rate may be going up, but the spread, the Greek spread, has a chance to go down once we get investment grade rating, which it could happen in about a year or two. Perhaps if the government does even a better job, if I see Mr. Staikouras smiling, then I'll say, gee, it will happen right away. So this spread may decline, so it will affect rates. Anyway, so interest rates is going to help banks, and it's not going to hurt the state sector. Now, another thing that has happened in the last 2 years, which you should notice, is the fact that finally the banking sector is supporting the economy. Namely, lending has picked up. And what I have on the graph is net corporate loans beginning of the end of December 2018 till the recent December. I have accumulated the net increase. Namely, it's not gross lending. Gross lending actually over the last 2 years was like about 25 billion to corporates by banks. The net lending, which subtracts the loans that are repaid, was like 9.2 billion. That's a lot of money for Greece. Remember, up until 2-3 years ago, credit expansion was negative. Namely, there was no new credit expansion, and people were paying off their debt. So the size, the stock of loans outstanding in the economy was shrinking. So now it's evident that it's going up. The banks do support the economy. The issue for I think for everybody is, I mean, liquidity is there. Money, we Greeks say money exists. Yes, liquidity exists right now. What the banks worry about are their bankable companies, and what we should do as a country, we should make sure we try to promote push the smaller companies to be more transparent, grow bigger, and therefore be bankable. Because banks will do have the money, they just need to see to observe the companies and see their business plans. Now, coming to the banks that I talked before, let me just give you a bunch of bullet points as to what the state they are in. Right now, they're kind of cleaning up with the past. They're reducing their non-performing exposures. I do have data, but I don't have time to show them to you. All I can tell you is I'm pretty sure 2 of the 4 systemic banks but the end of 2021 will go to single-digit non-performing loans, okay? Mr. Staikouras mentioned that all 4 banks, the whole system, by 2022 will be in single-digit territory. 2 of the 4 already are there. And I think by the end of 2022, some of 2 perhaps may reach the European average, so which is like 3% or something like that. So the banks more or less are kind of cleaning up their past, and it's time for them to look into the future. And also, they are building their capital base. I mean, we can spend time and tell you exactly what's going on. The reason they delayed cleaning up their loan portfolio all these years was not because they didn't like it, they didn't want it. Of course they wanted it. But when you clean up your bad loans, you lose capital. These losses hit your capital base, and capital is scarce. So now banks delayed, I mean, a bit, but now they do have a good capital buffer. The regulators are very tough on the Greek banks. I mean, now they want them to borrow, although they don't need the liquidity because of MREL requirements. Namely, they need to have outstanding bonds, that those bonds will be grabbed in case there is a bankruptcy. Anyway, these are European-wide rules. So that's the past. I think we're cleaning up the past. Now the banks are looking into the future. They're moving from playing defense, so to speak, now into the offense. And the big question mark in all of us is, how are we going to make money? Where would profitability come from? First thing they are doing, and I think the banks were the first companies that did it, is to make sure they have proper governance. And Mr. Staikouras actually had a new law a year ago, it's effective a year ago, of the proper governance in all the listed companies. And perhaps we should move to proper governance in non-listed companies, because transparency is the trick. So the banks are looking into the governance issues. They're looking into improving their human resource management, and their internal architecture. They're looking into themselves to be better, to be more efficient. They're looking at outside the bank, at their customers. They see the customers demanding. They see the young generations want to do everything from a mobile phone. So they're trying to, and we are investing huge amounts of money on digitalization. We know we have competition from fintechs, and we're looking there, and we think we can do it. And then finally, we have to cooperate with the state, because we have to attract that funding that's coming from the European Union and provide new loans. And then we have to worry about, okay, Greece may be small. We used to be all over Europe. The crisis shrunk us a little bit. DG competition forced us to shrink, by the way. It was not necessarily our will, but that's sort of the next step. And I have a final transparency to show you, and I'll stop, which is, I already told you that the banks are spending a lot of money on digitalizing. The state sector is doing it. We all know it. Here is some piece of data that are worth looking at, how the Greek public is adopting the digital world. In 2011, only half of the Greek citizens, Greek individuals, had access to internet. They were using internet. Now in 2020, more than 3/4, 78%. We're a bit behind the European average, but we're getting there. We're closer. We're closing the gap. The gap was bigger in 2011. In 2011, it was close to 20%. Now it's like 10%. Now, among the internet users, the question is, who are the people who are just playing games and talking to their friends and gossiping and stuff, and who are actually doing business? And I have you who are using e-banking, who are doing e-banking. Only 17% of the 52% in 2011 were doing e-banking. So in other words, less than 10% of Greeks were doing e-banking in 2011. And now half of the internet users, and that wasn't doing, are actually, who are internet, are doing e-banking. So the Greeks are full force, they have adapted, they are moving to new technology, the banks are following, the state sector is following, and I'm sure we're gonna move forward and we're gonna see good things coming in the future for our country. Thank you.
Thank you so much, Gikas. That was remarkable. Most helpful. You've raised a number of very important points concerning both the financial system and the structural development of the Greek economy, both in terms of governance structures and, at the end, innovation and digitalization. We will turn shortly, if you would mind turning off the...
I'm trying to stop share. Okay, I did it.
We will turn shortly to the final points that you've made, which are of critical importance, namely the ones relating to innovation and restructuring. Let me first, however, return to the issues raised by Minister Staikouras, and I would like to pose a question, again concerning, of course, fiscal affairs, fiscal management. Now, the Minister mentioned his commitment to a prudent fiscal stance, and more generally, I understand that Greece has achieved already debt sustainability for the medium term, also because of the term structure of the Greek debt and the fact that the new debt accumulates in nominal terms, but there is a snowball effect to the extent that the GDP grows faster than the debt. Nonetheless, maybe it is my central banking hat here which takes over, but there are headwinds. There are clear new developments. We are facing now a new environment. Professor Hardouvelis mentioned that in principle, a slightly higher inflation and positive interest rates are a normal thing. Normalcy is a good thing. Nonetheless, there are clear implications for Greek finances. So my question would be, your commitment to a prudent fiscal stance, would that translate into a reversal of the current fiscal stance, some sort of rapid abandonment of the support measures and the fiscal retrenchment more generally?
Thank you, Christos. First of all, I would like to make some comments on what I had before. We want this 3 to 5 billion euros from Mr. Fotakidis, from Alex, but in order to continue persuading him about that, we have to follow, as you mentioned before, a prudent fiscal policy. We should continue implementing structural reforms, and we are committed to follow that path. I would like to share with you what we legislated recently, and has to do also with LSE and young people coming from abroad. You know very well, Alex, I know is familiar about that, about the famous tax incentives for attracting new tax residents. In this case, we created a quartet of measures in order to attract investments, investors, young people, pensioners, family offices from abroad. Until now, in 1 year, we attracted, I have the figures here, 75 investors, 23 relatives of theirs, and more than 1,000 people have applied to opt for the special tax treatment of employees and self-employed. This is quite crucial, and I'm quite sure that Alex has already attracted people from abroad by taking advantage of that scheme. The second comment I would like to make this complemented what you asked before, Chris. Banking union. I heard Gikas mentioning banking union. We have not completed yet. We are moving towards completing what we started back in 2014. We had the European presidency then, but we completed the first two pillars, and we continue to discussing about the third pillar, the famous EDI scheme. So we are moving, if we take into account the RRF and what we did in the last 2 years, on a proper path at the European level, but we continue to have significant differences on key aspects. Bank rates, interest rates, the increase in interest rates are good for banks if they provide credit. You said that you provide credit. I agree on that. But also you mentioned something very important, which is the perimeter of bankable companies. And we should work collectively with services in order to enhance this perimeter. Regarding debt sustainability, what we mentioned before, Chris, I would like to give you concrete figures why we believe that even if we have increase in interest rates, we are not scared about this. First of all, debt portfolios, 20 years weighted average maturity, more than 19-year time to net refixing, 99% fixed rate, 90% fixed rate. Gikas mentioned before the ratio of debt to GDP. We have also the famous annual gross financing needs to GDP. This is close to 10%, almost half of all other Eurozone peers. Greek public debt held by official sector is more than 70% of the total debt portfolio. And finally, cash reserves yesterday night stood at 40 billion euros, around 20% of GDP, which is the highest among all other European peers. So more or less, we have proved that we keep debt sustainable. Regarding the fiscal side, yes, we have turbulences, but we are sticking on the target we set in the budget. Most probably, we wait for a couple of weeks in order to complete the figures for debt and deficit for 2021. It seems that we will be around 6 to 6.5% of GDP, minus 6 to 6.5. The target of the budget, and we are stick on that, is for a primary deficit of minus 1.4% of GDP at the end of 2022, and realistic primary surpluses, as Gikas mentioned before, from 2023 onwards. In order to tackle the crisis we face, simultaneously, we follow policies of permanent stimulation of household and business incomes. At the same time, we are launching a second largest increase in the minimum wage. At the same time, we are supporting job creation, and we maintain some targeted, I repeat the word, targeted support measures against the effects of the pandemic.
Minister, maybe I'm a bit pedantic here, but I hear you saying two things. In your original comments, you mentioned, and I found it very interesting. It's a small point, but important one, that you intend to build more cash buffers, more cash reserves. And now you've said that we have outstanding cash reserves, that we have huge liquid reserves at the disposal of the Greek state. And this, of course, is very good in terms of providing a buffer. But why do we need even more cash reserves?
I didn't say that. I have in front of me what I said.
So,
I said
this is what I understood.
Implementing a smart issuing strategy to maintain strong cash reserves. This means that, for example, we exited the markets 3 weeks ago with quite low interest rates, and we absorbed 1/4 of what we scheduled for 2022. By taking into account these high cash reserves that we have at the moment, we are not obliged to go out in the markets to raise money going forward. It depends on how the markets will react going forward. This is what I mentioned before. And we will use properly these cash buffers. So, for example, what will be decided in the following weeks is the prepayment of the IMF loan, of the residual of the IMF loan. This is extremely important in order to reduce what we have to pay to the IMF with positive feedback for the Greek budget.
Okay, that's a fair point.
I can give you concrete figures for the students by prepaying the residual amount of the IMF loan. This stands at 1.9 billion euros. We estimate that we will save 56 million euros in interest, raising to 230 million euros the total benefit of the three prepayments, improving debt sustainability, reducing interest rate and foreign exchange risk, and reducing refinancing risk.
That's a fair point. Concerning your other remarks, this brought to my mind two questions that I would like to ask. The one, however, I will address to Professor Hardouvelis as a banker. Before that, you mentioned the Recovery and Resilience program. And I wonder, how do you see the RRF? Is it, many Greeks consider that this is some sort of a pot of gold that will somehow magically solve all the financing problems of the Greek economy. It is a very important sum of money, but cannot cover all the financing needs of the Greek economy. Is it a catalyst, something that focuses minds like the Olympics in 2004? What exactly is the role of the RRF in your view?
I think...
Okay.
I'm sorry, Gikas, I would like to ask you about the other issue that the minister raised concerning lending to enterprises. So if you bear with me for a minute.
Okay, first of all, I share what Gikas presented us regarding not only the pre-financing, but also the total envelope as a percentage of GDP regarding the RRF. So this scheme is much more important for Greece compared with all other European members. However, if we take the absolute figures, we're talking about around 30 billion euros. The fiscal expansion in the last 2 years was 43 billion euros. We have 30 billion euros in the following 5 years, when we spent 43 billion euros in just 2 years. And out of these 30 billion euros, 19 billion euros are grants and around 11 billion euros are loans. So this means that this is a quite vital instrument for the Greek government, but we cannot resolve all issues through the reforms and investments that have been included on that scheme. At the moment, we have received the highest pre-financing of the whole European member states. We have already presented 103 projects with a budget of over 6 billion euros. And at the same time, which is extremely important, and oftenly this is a question that has been raised internationally when we are discussing about that RRF issue, is whether the Greek state is ready to implement all these reforms. And in this case, we have created a strong governance framework and designed a robust management and control system in the Ministry of Finance through the special RRF coordinating agency.
It will be interesting to hear what Mr. Fotakidis thinks about governance as an investor. But before that, I would like to somehow focus on one of the issues that Gikas Hardouvelis, who is very prescient, had already presented in his transparencies. He mentioned towards the end of his remarks that there is credit growth, solid credit growth. After many a year, Greek banks are now able to extend credit to the economy. Nonetheless, a criticism that I often hear and which has been debated repeatedly links to the perimeter issue that Minister Staikouras mentioned, namely that all larger bankable companies in Greece were able to refinance themselves with great success during the past 2 years, but Greece has far too many, if you ask me, small and medium enterprises. And when we are talking about small and medium in Greece, we mean very small in European parlance, do not get any credit because under pandemic conditions, it's exceedingly difficult to evaluate and valuate projects and borrowers. And then again, there is the following problem, Gikas, and I would like to raise it directly with you. It is still the case that even when credit is given by Greek banks, there is a significant spread between the lending rates that the Greek banks charge as compared to what an equivalent borrower in another country would get. And this, of course, creates a structural disadvantage for Greek business borrowers. How could we possibly address that?
May I say all these questions are around the same topic. First, the question on RRF. It's true, money started flowing in. Now, for the continuation of the money to flow in, the banks ought to kind of help companies and educate them of how they can attract those funds, because they're very funds have to go to specific investment projects. They cannot be like they used to be. I mean, it's very well organized. So the banks do have a role there, specific role. On the general issue of lending, what we observe right now, there is almost a bifurcation. There is these large companies that have access not only to bank finance, but also they can issue corporate bonds. Remember, about 4 billion of corporate bonds were issued. And I've showed it, I forgot to mention it, but it was in the graphs. And they're good companies. Their accounting and their finances are visible, they're transparent. And we have 4 systemic banks, and they compete to offer them at very low rates, loans. So the spread you mentioned, Christos, before, when it comes to the very large companies, are very small. Of course, bankers, it's human nature. If they can get a job with one big company, they can show that they have provided huge lending. So each individual banker within a bank pushes very hard to get these deals, these accounts, these big companies. When it comes to smaller companies, that's where the problem is. And that's where I think the state can help. And I kind of alluded to this before. And already, Mr. Staikouras, we have to mention this. A year and a half ago, I think it was July of 2019, and then, or no, July of 2020, and then in July 2021, he pushed all the listed companies to adopt a transparent governance framework. You should have a governing body that's not the your niece or your uncle or the dentist become the head or supervise the accounts. There has to be transparency, and transparency has come to the big companies, and that helps them attract funds from all sources. Now this has to go down to lower size companies. So the perimeter will increase the moment those smaller companies become more transparent, and they're pushed to become more transparent. Perhaps there should be some incentives, and I guess the government is putting incentives for mergers of smaller companies. Incentives make it easier for them to show their finances better. That whole community of small companies need to understand there is a set of rules, of accounting rules, and they're transparent. And if an examiner comes and checks their books, the tax examiner, because you have to have tax books and the other, he doesn't have a lot of leeway to doubt what they have shown. In other words, we need a transparent framework that everybody understands and follows it. And therefore, the little guy is not afraid of the examiner, and he's not even trying to avoid showing his profitability somehow. So I think that's how the perimeter will increase. If you were to ask me, it's a difficult issue, and I'm optimistic because the economy is picking up, because money is flowing in. Somehow companies naturally are becoming more profitable. It's easier for them to show their good prospects, and it's acceptable for them to be taxed, and somehow transparency will come. Usually it's easier to reform in the good times. It's very difficult to reform an economy in bad times. So since good times are coming, I think we're moving in the right direction.
So point interrupting, I fully agree with what Gikas mentioned before regarding the perimeter of bankable companies. I'd like to add one comment. It's extremely important to take advantage of the new insolvency law. The implementation of the new insolvency law can be used both by banks and the services in order to improve the perimeter of bankable companies. It's extremely important.
Yeah. And I forgot to answer one question.
I'm sorry, because we have to.
I forgot to ask you to answer one of your questions. The spread you said is big, the interest rate spread. It reflects the risk. If the companies do not have transparent finances, that higher risk is reflected in the higher spread. That's obvious. That will go down the moment there's more transparency and visibility.
Before we turn to the floor's questions and open the discussion, there are some things that I would like to ask Mr. Fotakidis. His remarks at the beginning were very informative, quite succinct. So I would like to ask him to elaborate a little bit. There are three dimensions on what what he said that I would like him to somehow expand on. The first is essentially, why Greece? You're a major international private equity fund. Of course, many people perceive of Greece as a high-risk country. There is an upside, a significant downside. What are the comparative advantages that you've seen? The other two questions concern governance and innovation, and your investments, the more innovative ones. But let me start with this more general issue. Why Greece?
Well,
because I'm interested, maybe the other people listening to us do not know it. It came out from your remarks, but the CVC has come very strongly. Mr. Fotakidis already mentioned 5 different areas, but in terms of the numbers involved, even as compared to the total portfolio, this is a very significant exposure.
And it is by design, Christos. We are originally a European private equity firm. We're global today with offices in Asia, the Americas, but our heritage is Europe. And with that, when we look at Europe, we're not only investing in Western Europe and the large economies, we want to be investing across the whole of Europe. And like with Poland, where we opened an office in 2015, 16, when we started looking at Greece and the opportunity to invest here, as I said earlier, we did it with small steps, but and maybe a little bit tying everything together that we've been discussing. The RRF is in a way solving the huge underinvestment that the country had maybe between, say, 2010 and 2017 on a macro level. I think where we come in is we're here to actually to help build better businesses and better markets. And really, we're addressing the underinvestment on a micro/market level. And I think it's worth maybe spending a few minutes explaining the themes that we have and why we want to invest in Greece, and also go through a few examples. And really, when we've been looking at the market, there are 4 investment themes. One is consolidation. So what happened during the crisis, there was virtually no domestic M&A from 2010 to 2017. And we saw an opportunity in several sectors: healthcare, insurance, consumer, where private equity can play a positive role to build better businesses through M&A. And we'll go through specific examples in a minute. The second investment theme that we saw, and we're seeing, and not only at CVC, we're seeing it with other investors, there's an opportunity to support local companies to grow. And we saw that with Scrooge, where we're supporting the founders. We're seeing that with, for example, Pharma10, where other investors came in, companies that are based in Greece, healthy companies, either growing quickly domestically or growing internationally. Viva Wallet, as we mentioned earlier, another one. Having institutional capital to support that growth is another theme. The third thing that we saw, and it is particularly relevant to Greece, and again I think was delayed by the crisis, is succession planning. We see many businesses, and sizable ones even, which are still founder-led, successful, entrepreneurial, but sooner or later there's a need for an institutional partner, whether that's private equity or a strategic or a combination, to help the founder, the entrepreneur, with succession planning. And I wouldn't be surprised if there's 2 or 3 transactions in the next 2 or 3 years, billion-plus euro transactions that are around that theme of succession planning. And then the final theme, a little bit as we talked about, and in the examples, is we're seeing more and more opportunity now to support businesses that have a Greek nexus, but are not necessarily driven by the Greek economy. Again, that could be businesses that are headquartered here, or Greek founders that spend time in Greece, companies that have production, R&D here, but rely on international markets for sales. We're seeing that throughout the ecosystem, smaller companies as well. In the next few years, there'll be a need for institutional capital to support them. And the way we look at it, since we've decided to come here, we're not here because we want to take advantage of the next 5 years. We've decided that we want to continue investing in Greece long term. The objective is to make 1 or 2 investments every 2 or 3 years, invest at least 250 to 500 million euro in each new investment, and then continue investing in the portfolio and adding to that. And just maybe a few specific examples to sort of give color to the themes. If we look at the first major investment that we made with Hellenic Healthcare Group, And really that's been a 5-year journey in 3 stages. There was deleveraging, and there was catch up, and now there's growth. What do I mean by deleveraging? In all of the acquisitions that we made, Metropolitan General, Moderator, not only did we pay down bank debt in that process, and that needed to be done to strengthen the balance sheet, we also paid down payables in the sense that you had suppliers, employees that had delayed payments, and really just getting the balance sheet in a more healthy position. And then the second stage, there was a really significant catch-up. And if you look at our portfolio of hospitals, we have invested 120 million in capital expenditure the last 4 years, updating the facilities, replacing, upgrading equipment, and also making new investments. And now we're seeing the third stage of that, where not only we're seeing strong growth locally, we're seeing the opportunity to invest in adjacent markets. At the end of last year, Hellenic Healthcare Group acquired a hospital in Cyprus and can now play a leading role in helping consolidate that market. And the overall theme there is we're looking to create a positive, sustainable cycle in that market. We want to maintain the best healthcare facilities with the best equipment to attract the best doctors and provide the best healthcare services. And that becomes a virtuous cycle. And it's good for the market. It encourages the competitors as well to do the same and invest. And we're seeing that. And now we're seeing a much healthier healthcare market in Greece, which is attracting doctors from abroad. We're regularly getting CVs from the doctors in the UK, Germany, the US. At the same time, we're seeing patients not wanting to go abroad anymore because they're happy with the healthcare services that are available here. So I think that's a really good example of where private equity can have a positive role, not only in a specific company in terms of helping it delever, helping it catch up in terms of underinvestment, but then also fuel growth, but also even help the entire market improve. And it's I guess the theme of the panel. We as well as private equity, we're constantly looking to improve the companies that we support. And we're starting that journey today actually now with Vivatia. Vivatia is another good example that in 2020, heavily levered company, a lot of debt at the operating company level, a lot of debt at the holding company level. And actually 2 of the 4 banks there were looking to sell the loans, which would have led to a distressed situation. And we're talking a group here with 5,500 employees, very important for the economy and for the local communities. And we took the view that actually we're going to have a long-term strategy here. We're going to de-lever the company. We put in more than 75 million to reduce the debt at the operating company level, acquired the equity, and we're now in the phase in 2021 where we invested significantly in CapEx in the production facilities, in M&A to help strengthen verticals within the business. And today we're in a challenging environment. We didn't really talk about it, but we have significantly increasing raw material prices and significantly increasing energy. But the good news is a group such as Vivatia today, starting 2022 with more than 100 million of liquidity on the balance sheet, it can withstand and weather the kind of volatility that we're seeing and continue to invest and grow. And that's what we want to do in that market, and we're seeing it also from other players. And finally, with the insurance sector, and we're talking a market that's 5 billion in Greece, 78 insurance companies, significantly underinvested during the crisis as a market. If you look at where other markets are in terms of digital investment, for example, also significantly underpenetrated. Per capita spend in Greece on insurance is around 600 euro, when in Portugal it's 1,000. And I think what we wanted to do there, and hopefully when we close the Ethniki transaction, is we're going to invest significantly. We've already budgeted 75 million IT and technology spend for Ethniki. And we're seeing also in the market, if you look at what happened since we got involved in the market, we had Generali merging with AXA, and then with MedLife, most recently European Reliance with Allianz. I think ultimately what will happen is you're going to have a healthy market with 7 or 8 strong competitors who have the balance sheet to invest in the business, invest in the people, and help grow the market, grow penetration, and ultimately provide better services to the consumer. So we're really excited about the journey that we've been in with the healthcare platform. We're excited and a little bit concerned also with the challenges we're seeing with energy prices and with raw materials. But we feel that coming out of 2022, we'll have a better business also in the consumer side. We're excited about the platform that we're building in insurance, and of course Scrooge as maybe the final one, which was an incredibly healthy company when we joined, and really I think what the founders were looking for there was an institutional investor to help them fuel their ambition. When we invested in Scrooge in the summer of 2020, the company had 250 FTEs. Today the company has more than 650 FTEs. And this is in the core price comparison marketplace. In addition, we've made investments in last mile. We have a micro courier which has more than 100 employees now in management and operations, collaborates with 500 drivers. We've invested significantly in electric vans. We have more than 30 electric vans. And also we've invested in a payments business, EveryPay, as we're looking to build out the infrastructure on that. And that's also an incredibly exciting project, which we would like one day with Scrooge, once we have completed the investment journey in Greece, see if we can replicate in other countries, adjacent markets, and take the Scrooge playbook to neighboring countries around Greece.
Let me interrupt you here. Before I pass on to the questions from the audience, in fact, my question will lead directly into the first question from the floor. But let me ask you the following to conclude our part of the discussion. You have illustrated perfectly well the logic of your investments. You have also illustrated perfectly well the role that private equity or external financing, foreign financing, can contribute both to the funding and to risk spreading in the case of the Greek economy. What I still find puzzling is, what about the downside risks? Doesn't CVC think about or is not concerned about the well-known governance problems, legal risk problems, the issue that Minister Staikouras mentioned concerning the insolvency situation and enforcement of claims in Greece? Or do you see that the governance system of the country matures to such an extent that you can feel more confident now to invest in Greece? And then, in order to conclude my set of questions and to lead into the innovation part, which the audience is also very much concerned about, at the very end you mentioned Scrooge and payments. In connection to the Scrooge transaction, you mentioned also the payment issue. What about fintech? Are there any, already the fact that we invest in platforms shows that you are interested in innovation. Do you see a way forward in fields such as fintech or other high-tech digital economy projects?
Sure, Christos. There's a few questions there. Let me start with the first one around the downside risks. I mean, we did a lot of work back in 2016, 17 before we made our initial investment. And also, as we've now been investing in the country, obviously we learn more and more, and that helps inform the investment committee and the board at CVC. And I think having developed that informed view the last 5 years, you're seeing the output of that. But the reality is, if you do look back, and I think the points were already made, and I don't want to repeat them, but let me see if I can expand them a little bit. But fundamentally, what we did is we did actually look at Greece in terms of, let's think of it as a balance sheet, P&L, and cash flow. And the reality is there's been a huge refinancing exercise that has been taking place. And as both the other panelists mentioned, we do now have a sustainable debt profile. And if you look at the weighted average life, more than 20 years, let me remind everyone, the US has a weighted average life, the US Treasury, 6 years. And our fixed cost at 1.4, 1.5%, the same as the US. And actually in the US, a lot of it's floating. That together with the cash reserves that were mentioned, and the way we think about the economy, actually, and this has been an exercise both locally but also with the EU institutions, the momentum is one way. We think Greece is now on a fairly narrow corridor in terms of reform and growth, and whether the country walks or runs, to a certain extent, depends on the governance. Maybe under the previous government, there was walking in small steps. I think under the current government, with all of the work and the reforms that have taken place the last 2 years, we see actually the country running. But the direction of travel, in our view, is one way. The foundations are lined up, primarily around the sustainability of the debt and the decision in the governments, in our EU partners, that we're going to support Greece. And I think also the lining up, and as we mentioned, the country is moving towards investment grade. And all of this, what we're seeing is there's strong and growing institutional appetite, both public and private, to invest in Greece. And it's not a coincidence that we have 30 billion plus of RRF that has been approved by the EU. And it's not a coincidence that we have invested 1.5 billion of equity the last 5 years, or that in last year there were several billion plus transactions. Pharmatech with Partners Group, Hedna with Macquarie, Chipita with Mondelez, or that there were several billion plus capital raises last year with Piraeus Bank, PPC, and of course this year started strongly with JPM and Viva. So I do think the foundations are there. There will be risks. We expect there will be 3 to 5% annual growth the next 3 to 5 years, but there will be bumps along the way. And at the end of the day, our job as investors is, we assess that risk-reward opportunity. And I think the key difference today for Greece is when you look at that risk-reward opportunity, there's a lot more comfort that you can make investments, and as long as you have the time and the capital and the right partners to weather short-term volatility, whether that's the pandemic or energy, then ultimately you're going to end up having good returns, because in 3 or 5 years you're going to have companies that are better, that have grown, sustainable revenue profiles with healthy also ESG. And we talked about governance, and it's not only about governance, but even the environmental footprint and the impact on society. And I think what's going to be happening, what I see from my fellow investors, there's increasing desire to look at investing and joining that journey. And the second question around fintech, I'll maybe respond with an anecdotal comment. When Scrooge looks to invest in Everypay, actually we considered either doing it in-house by making the investment in Everypay, or actually outsourcing to one of the global players such as Checkout.com, Stripe, Hayden. What was incredibly interesting when we did the compare and contrast, for what we need in Greece, Everypay's technology was just as good, if not better, than what those international players who are worth tens of billions could offer. So actually, we chose to go with a local partner for the Greek market. And so I do think That is one example, and hopefully we can help that business grow much in the way that JPM will help Viva Wallet grow. And I'm sure there'll be many more examples.
Let me pass on to the questions from the floor, and the first one is closely related to what we have just been talking about, innovation. Maybe Gikas Hardouvelis could help with that. Can we be optimistic? Is it realistic to believe that the Greek state can handle the climate change challenge properly, and also what implications, I would add to these questions, does this have for you when you are assessing the financing needs of the green transition? So what, in short, are your views on the real prospects, not the rhetorical emphasis on green transition?
My sense is the Greek state has already started, by on the energy sector, for example, we're abolishing the lignite enterprises in northern Greece and in Peloponnese. And when it comes to the banking regulator in Europe, they are very strict on the banks, on the green targets. They want the banks to be carriers of reform, of company reform. They want the banks to make sure where they lend money. If they lend money to polluters, they're going to be charged extra capital. So the effort has already started. Of course, it's costly. I mean, it's not easy. On the other hand, because when we think about green energy, we always think about energy. We should reallocate our efforts and improve our supply of energy through the sun. We have plenty of sun. We should utilize it. But yeah, I mean, it's not only a Greek problem. It's a global problem. Europe is a little bit on the forefront on this, relative to China or India, for example. Remember that we have a net zero policy in Europe by 2050, and the Indians did not sign up to it. They wanted to 2070, I think, and the Chinese the same. I'm not sure about the Americans. Anyway, I think we're moving in the right direction.
I agree, and one of the reasons we decided to invest in PPC is because the company is moving towards being a digital green energy business, and actually in the next 5 years, I think PPC is planning to invest more than 3 billion in renewables, 70% of which is solar. And we're seeing also in our portfolio companies where one of the ways we're seeking to address energy costs is actually becoming more self-sufficient. For example, putting solar panels on our production facilities in Athens and Thessaloniki. That with the help of RRF, but that will help reduce our energy costs by more than 50%. And in line with the EU's statement, we as CVC are committed to be net zero by 2050 across all of our portfolio companies, and so we have to start today. And I'm pleased to say that actually when I look at what we're doing in Greece in our portfolio companies compared to the rest of Europe and even globally, we're on track. A few weeks ago, Dodoni got a gold sustainability rating from EcoVadis. Dodoni is considered in the top 7% globally in terms of sustainability and corporate social responsibility among dairy companies. And next year it's going to aim to go platinum to put it in the top 3% globally.
May I add the government dimension on this issue regarding the green transition? The Prime Minister has set the priorities and the targets ahead regarding the decarbonization of maritime transport, the how we'll achieve the fully green and energy autonomous destinations regarding the islands, how we will complete the Lignita 3 by 2025. In the Ministry of Finance, we have set 3 priorities. First of all, we take full advantage of the RRF by using 38% of the whole envelope in order to make investments, to attract investments and to make reforms on climate mitigation and adaptation. The second issue is that, complementary to that, we are exploring the option of issuing green bonds. We are planning to build a solid portfolio of eligible projects to be financed through sustainable bonds in forthcoming years, and we are scheduling a debut deal in the second semester of the current year. And finally, by taking advantage of the European experience, we are working towards incorporating climate considerations into our budget by having a green budget. And we are moving towards that direction from 2022 onwards. Thank you, Christos.
We have some very interesting questions, written questions, but we need to open the floor to the persons attending physically. So if I can ask the organizers to help with that and they give access to the microphone to people who want to ask live questions.
Christos, if you want, I can answer in 2 questions coming up from the audience through the chat.
Yes, but before that,
okay,
we need for a minute to turn to the live audience. If it's not technically possible, of course, Minister Staikouras, you can.
Hello,
can
you hear me?
Yeah, now we can hear them. From Hong Kong Theatre, they talk to us. Yes, please.
Thank you all for your insights on the Greek economy. My first question is addressed to Mr. Staikouras. Mr. Minister, you may have touched upon this already, but when do you expect the high electricity and gas and energy prices in general to de-escalate? And what are your main countermeasures towards these price increases? And the second one is more related to the banking system. We have seen central bank balance sheets change in their composition with QE, more long-term liabilities than short-term, and less use of currency. And how would you say a digital coin from the central bank would benefit central bank seniorage and would help the stability of the banking system? Thank you.
Okay, thank you. Okay, thank you. So I will answer in these 2 questions, concrete questions, and I will add one more coming up from the chat in order to complete my intervention. Regarding the energy crisis, which is the main cause of inflationary pressures in Europe compared with the US, has exceeded in duration and intensity the initial global projections and estimates. In fact, the European Commission recently updated their projections from 2.2% at the European level in 2022 to 3.5%, a significant revision of their estimates. The de-escalation of the problem depends, first of all, on geopolitical developments and the supply of gas. But additionally to that, it has been caused due to different factors, like, for example, the discrepancies between the supply and demand of goods due to the COVID-19 outbreak, but also taking into account the expansionary fiscal and monetary policy. So de-escalation is estimated at the European level in the second quarter of the year. At the same time, the weapons we have to do with how we will, on a permanent basis, increase the disposable income of household enterprises, how at the same time, as I mentioned before, we will increase the minimum wage, and how we will maintain some targeted support measures coming up from the COVID-19 outbreak. Now, regarding the Euro digital coin benefit for the Europe, we support it. As a Greek government, we support it. Basically, it is an ECB's perspective of how they will implement it, we believe that this will increase consumer demand for instant finality of payments. It will create vast changes in the retail payment ecosystem. It will maintain EU competitiveness at international level vis-à-vis other central bank digital currencies. But at the same time, we should be sure that this will not create problems in the monetary policy. And finally, it is crucial for the ministries of finance to ensure access to the digital euro for the entire population. And this should also take into account the prevalence and level of digital skills. And finally, I saw a couple of questions in the chat regarding how will help SMEs, how will attract investments, how will reduce bureaucracy. In this case, I can give you 5 concrete arguments. First of all, we have helped to improve banks' balance sheets. Of course, banks are taking their own responsibility and their own initiatives and actions in order to improve their balance sheets, but we have done it through the Hercules scheme on the asset side and through the increase in deposits and the cost of funding on the liability side. In this case, there is room for maneuver in order to enhance credit expansion. The second point has to do with the loan portfolio of the RRF. Well, we're talking about 12 billion euros. In this case, we have signed business agreement with credit institutions and international banking institutions like EIB and EBRD in order to utilize the loan portfolio of the fund. The third argument has to do with the insolvency law. The insolvency law is extremely important in order to reduce private debt which skyrocketed in the last decade. The fourth argument has to do with the with the fiscal policy. We have reduced taxes and social contributions. And the final argument has to do with structural reforms. I have in front of me 130 reforms that we implemented in the last 2 years. Just to pick up, just on sentences, the most important of them that have to do with SMEs, bureaucracy, and how we'll attract investments. Amendment of the legal framework for the attraction of strategic investments. Reducing tax rates on labor. Simplification of business licensing and investment licensing. Reforming the legal framework of public procurement and contracting. Activating the Hellenic Development Bank. 5G technology transition. Reforming the legal framework for PPP's preparation and monitoring. Introducing tax incentives for research and development expenses. Entering into force tax incentives for angel investors. New legislation framework for simplification and acceleration of environmental licensing. 4-year planning cycle for public sector recruitment. Statutory framework for public sector teleworking. Adoption of digital transformation Bible for Greece. Single declaration for birth and death events observing principle once only. National framework for procedure simplification. Law for digital governance. Launch of digital strategy for justice, and many more. So these are the basic pillars in order to provide liquidity to the real economy, especially SMEs, in order to attract investments, especially young people from abroad. Thank you.
We have essentially reached the end of our time. I will allow one more. Just a minute, sorry, Gikas, but I need to manage time here. Of the written questions, Gikas has answered one, Mr. Fotakidis effectively another one, indirectly. Minister Staikouras too. We have also had one question from the Hong Kong Theatre. If there is another question from Hong Kong Theatre, let's hear it now and let's end with that one.
Hi, yeah, many thanks for the insightful panel. I've got one final question, if time allows. The question kind of relates to the current broadening of ownership, of state-owned enterprises in Greece and privatization. This is kind of a trend that's been picking up. The question is, what's the current government's strategy for private managers to effectively have incentives to act in the public interest, whilst including efficiency, obviously, and how do you see this trend evolving in the future for privatization in Greece?
Who would like to answer that? I suppose it's addressed either to Gikas. Let's Professor Hardouvelis answer that one.
No, this has to be answered by the minister. What I want to answer a question that was not answered before, which is about the central bank balance sheet and seniorage.
Fair enough. So let's hear from you, and then let's conclude with the answer of the minister to that question.
I don't see a big problem. I mean, I know central banks have accumulated lots of assets, like close to 9 trillion, I think, in Europe and so in the US. And the experience from the US from 2016 on showed us that they can actually reduce their balance sheet without really affecting the markets too much. So I think the ECB can slowly reduce its balance sheet if it decides to do so, without necessarily jacking up interest rates that much. And in terms of seniorage, we have seen in Greece that despite the fact that currency is not used as broadly anymore after the capital controls and after the pandemic, still the central bank is earning a lot of cash to distribute dividends to its stockholders. We have a peculiar central bank that has stockholders and actually distributes out the dividends. So I don't see seniorage as a big issue in the future. Really, when it comes to digital coins, it's most like convenience of payments. And I don't see these digital coins being dominating. I mean, because a coin has to also be a unit of account, and it has to be a source of a unit of keeping wealth, and crypto and all that stuff cannot fulfill these roles. They fulfill other roles. So there is room for central bank to have digital coin and digital currency, primarily to help society do payments and do its finances in a more effective way and an easier way.
Excellent. Thank you so much, Professor Hardouvelis. Minister Staikouras, let's conclude with you.
A couple of comments. We have implemented a lot of privatizations in the last couple of years. We have, without having all these obstacles that was mentioned before. On the other hand, we have to provide some incentives, salary incentives, and this is an issue in the public sector. We have not this issue regarding privatizations, HRAD or HCAP. They have some room for maneuver, but we are working collectively as a Greek government in order to provide targeted incentives in the public sector. This is an issue for the public sector in order to improve its competitiveness.
Gentlemen, thank you so much. That was delightful. That was the most clear-cut assessment of the situation. Your comments were exceptionally valuable. No minced words here. And at the end of the day, a rather optimistic assessment of the situation going forward. Let me say how thankful we are to all three of you. We are also very thankful to the audience which attended this brilliant event. Ladies and gentlemen, thank you and good night. Bye.
Okay. Bye.
Thank you, everyone.
Bye.